In this video, we're going to discuss some examples of permanent differences between book income and taxable income. So, any life insurance proceeds are always going to be 100% tax-free. So, if the CEO of your company dies in a hang gliding accident and his or her life was insured, then any proceeds from that life insurance policy are going to be tax-free. However, any of the premiums that were paid, those are the monthly payments to basically have the life insurance policy, those premiums are not going to be tax deductible. And the reason is the IRS does not allow any expenses that are intended to produce tax exempt income. So if there's some kind of expense that the goal is to produce tax-free income, then that expense is not going to be tax deductible, because it'd be like giving you a double tax benefit, right? If you could deduct the premiums for the life insurance and then get tax-free income when someone dies, then you'd be getting a double tax benefit. Also, if the firm engages in some kind of bad behavior, right? So let's say they're fined by the Environmental Protection Agency for dumping chemicals in a river. In that case, they're not going to be able to get a tax deduction or any kind of tax benefit from that fine. And now, in certain cases, with what are known as qualified stock options, so this isn't just any stock option, but with qualified stock options, the firm will never be able to get a tax deduction. Municipal bond interest, so basically a municipal bond is when the firm basically buys a bond from a state or from a municipality or so forth, some local government. They buy a bond and then they get interest from that bond. So that's not going to be taxable for purposes of federal income tax. So that's going to be a permanent difference. It's going to be included in book income, but not in federal income tax. Now, if your company has a foreign subsidiary, I've just abbreviated here sub, but if any foreign subs that your firm has, if they generate earnings and then those earnings are permanently reinvested, then that's not going to be taxable. Now, goodwill impairments. So if the firm does a goodwill impairment, you'll see that for book purposes, you'll see that the firm has a big write-down and said, look, we have this huge impairment, so we have this huge loss. Well, that's not going to be tax deductible in like almost all cases. There are certain exceptions where there might be some tax deductible losses there, but generally speaking, just assume that any kind of goodwill impairment is not going to be tax deductible. Also, the domestic production activities deduction, which you sometimes hear people call it DPAD. So the DPAD is basically this deduction to give American firms an incentive, or give firms an incentive to produce in the United States. And so it's going to give a tax deduction. Now, this is going to be excluding some of the income for tax purposes, right? You might be getting 9% deduction or so forth, and that could change on a year-to-year basis. But that's excluding some of the income that was included in book income. It's excluding it for tax purposes. But basically, you're getting a deduction. And so, also, if a firm has, let's say that you've got one company, and then that company invests in another company, and then the other company that you've invested in pays dividends, right? So one firm receiving dividends from another firm. So basically, there's this thing called the dividends received deduction, sometimes DRD people call. So the dividends received deduction allows that firm, when it's receiving dividends from another firm, to deduct some of those dividends, and in some cases 100%. It depends how much they own and so forth. But the reason is that usually when you have a corporation, the corporation is taxed on its income, and then it distributes dividends to its shareholders, who are getting their taxed the second time, right? Because they're taxed on their dividend income. And so it's two layers of taxation. So the IRS says, well, look, if one firm is receiving dividends from another firm, and then this firm is going to pay tax, and then the shareholders will, that's like three layers of tax and so forth. So they come up with this idea of the dividends received deduction, but that's not going to be a book deduction. That's going to be a taxable deduction. And also, in some case, with natural resources, so if there's some kind of natural resources, there might be a situation where actually for tax purposes, the firm is allowed to recognize depletion expense in excess of its cost. So to the extent that it's able to recognize any of the excess depletion, that would be a tax deduction, but it wouldn't be recognized in book income.